FedEx just issued a terrifying warning. I'm Steve Van Metre. Shipments are crashing, fear is spiking, and as you're about to see, what's coming for the U.S. economy is outright frightening. Plus, while others buy the dip, my subscribers are up 8% in 11 days. Stay tuned to the end of the show to learn how you too can beat the machines for big profits. Now, let's head over to Bloomberg, where we picked today's story up with a headline. FedEx falls after outlook cut again amid economic worries, and many people look to FedEx for a pulse of the U.S. economy, because when the economy is booming, people are shipping and packages are moving through the economy. And the problem is, for several quarters in a row now, FedEx has warned that demand is falling, shipments are declining, and what they just said is we're on the cusp of another move down in the economy. And FedEx is the latest U.S. company to sound the alarm amid weakening consumer confidence and potential fallout from President Donald Trump's escalating trade war. The parcel company, considering an economic bellwether because of exposure to a broad swath of the global economy, says latest outlook assumes the global economic, political, and trade environment doesn't worsen any further. Now, I want to know from you, weigh in the comments, do you think the U.S. economy is getting worse? Do you think we're at the bottom and is turning around? Because the problem right now is, again, for several quarters, FedEx keeps saying things are getting worse. And if they do, well, what it suggests is we're headed into an all-out recession. Its shares fell as much as 12% this morning, and that's a major warning sign for the broad equity market because investors continue to buy the dip. But when you look at the relationship between FedEx and the S&P 500, what they're warning is that not only is the U.S. economy headed lower, but the stock market as well. Here you can see FedEx in green and red as it heads higher, the S&P 500 in purple. So where FedEx goes, the broad economy and the stock market follow. You can see when FedEx heads down, well, at some point, the broad equity market goes down with it, and then they both turned higher together. Now FedEx, major gap down this morning that investors are buying, but still a warning sign for the broad U.S. equity market, saying more pain likely to come. Like others in the market, FedEx was not able to sidestep an uncertain macro environment. And that's the problem, is nobody's going to be able to sidestep this macro environment, because the issue is it's affecting American households. It's affecting paychecks, and nobody is immune to this, because when demand goes down, when paychecks shrink, people spend less money, they buy fewer things. And what that means is less demand for shipments. And it goes all the way up the supply chain to the factory level. So when FedEx comes out and says, look, we're seeing a major decline in shipments and we're not seeing signs that this is getting better, what it tells you is the U.S. economy is headed in the wrong direction. And let's take a look at what FedEx has experienced in real time. As we take a look at the consumer price index against real retail sales, that's shown in red, both on a year-over-year rate of change. And so what the issue is right now is we know prices are rising and are likely to go higher due to the tariffs. And as income growth slows for many American households, what that means is real retail sales are on the decline. And for companies in the transportation sector like FedEx, when the economy turns around, they're one of the first to see it. But at the same time, when the economy slows, they see the impact before everyone else. And you can see that happen here in the late 1990s as inflation takes off. Consumers can't afford higher prices. You see decline in demand in real retail sales. This is exactly what's impacting FedEx and other companies in the transportation sector, as we see inflation rising into the global financial crisis and real retail sales get crushed. You see that happen around 2010 into 2012. Now, you don't see it happen here around 2016 because the economy is strong enough. And again, this doesn't happen every time, but it happens frequently enough that we can go back to 2022. And even though we saw disinflation, paychecks shrunk as well. Real retail sales here getting crushed. What FedEx is saying is there's no sign of a turnaround in the U.S. economy. In fact, what they're indicating is things could get worse and fast. Higher than expected inflation in the current quarter is putting pressure on costs, meaning FedEx looking to raise their prices as well. Weakness from industrial customers is weighing on services that cater to businesses. And this is why FedEx is such a bellwether stock, why they're such an important indicator of where the U.S. economy is going. Because when demand picks up, it goes all the way to the factory level. And when they see shipments increasing to their industrial customers, well, what it tells us is demand from consumers is rising. Right now, FedEx warning demand is falling. And that's why their stock is getting crushed. But your portfolio doesn't have to get crushed along with it, because check out this trade of Brazil resilient equities we put back on the 10th. And despite the sell-off yesterday, our subscribers are still up 8.18%. And you too can trade the markets and win. Hit the links in the description below. Grab the coupon code for a 30-day free trial, or stay tuned to the end of the show to learn more. The broader industry has been suffering from a prolonged period of weakness due to cash-strapped customers spending on services rather than goods. And it has nothing to do with customers spending more money on services. And even though after the pandemic we saw a preference going from goods to services, the real issue is customers are cash-strapped. They're seeing their paycheck shrink. And when they see that happens, they spend less. And it doesn't matter what it is, goods or services, because what have we heard from the services sector recently? Demand is falling there. And a growing preference for slower, cheaper delivery options instead of more profitable express shipping. It makes perfect sense when paychecks are shrinking and household budgets are tight. Well, you don't opt for express shipping when you need something. You take the slowest possible option. And here's the evidence that paychecks are shrinking as we look at average weekly hours of production and non-supervisory employees in blue against real retail sales in red. And when there's a drop in weekly hours worked, there's an immediate impact on retail sales. Paychecks shrink, people spend less. You see that happen in the late 1990s going into the dot-com bubble. It happens at the beginning of the global financial crisis, again around 2014, and look what's happening now. That big drop in retail sales had everything to do with hours worked getting crushed. And again, this is why FedEx is warning that things are getting worse for the U.S. economy. They're not seeing a bottom, and based on the data we're looking at, we're not seeing one either. And they're not the only one, as Nike comeback bid is threatened by inventory reset, and this is something that nobody saw coming. Nobody said we can have an inventory recession, because if we do have one, this could lead to all-out deflation. Now, the risks here are pretty high because going into the tariff war, a lot of companies have already stacked up on top of their large inventories. For companies like Nike, it's a dangerous situation. Nike is in the midst of clearing out stale merchandise through heavy discounting as demand fades for some of its bigger sneaker franchises, indicating elevated inventory levels across all categories. And this is a major problem not just Nike, but a lot of companies are facing. They have too much inventory. Now, what this means is we're likely to see further disinflation, perhaps even deflation into the U.S. economy. And this is going to be a challenge because when companies have too much inventory, well, they cut back on their purchases at the factory level. For American workers and for workers all over the world, this is a major problem. The company is trying to turn things around against a backdrop of weak consumer spending and fall from President Donald Trump's escalating trade war. China also remained a weak spot, with sales missing analyst expectations amid a prolonged consumer slump in the market. And it makes perfect sense why demand in China is falling, because they're the world's largest exporter. So when demand for consumers from all over the world declines, it hits the factory sector, their paychecks shrink, and in turn their workers spend less. It all starts to backfeed, and what this means is next thing is going to hit is layoffs. Because let's take a look at what happens when weekly hours decline against retailer inventories. You see that in red on a year-over-year rate of change. So when paychecks shrink, that means demand goes down. Of course, retailers don't need more inventory. They cut back their spending to drop their inventory levels down. You see that going into the dot-com bubble. You see the big decline in weekly hours led to a huge contraction in inventories throughout the global financial crisis. You see it happen around 2013. You see it start to happen in 2018, and look at now, inventory levels have been rising because everyone's been expecting an economic boom. At the same time, hours worked are on the decline. So what this means at the factory level is people are going to see a further cut in their hours. There's going to be job losses in a big way. And the performance shows that a turnaround is beginning to unfold, but the company still has a lot of work to do to reduce inventories, and that's the issue. They're going to have to cut prices, but the problem is they have been cutting prices and consumers aren't responding. That means, again, for the factory level, you're going to see a major impact, because now we're going to look at durable goods new orders. That's shown in blue against retailer inventories. So you can see that when retailers start to feel they have too much inventory and they slow down their demand, well, it impacts the factory sector. You can see that happen throughout every cycle as retailer inventories start to decline and even contract into the dot-com bubble. That new orders also went down. You see that happen around 2004. It happened again around 2006 where retailers began to pare back their inventory levels, and it hit the factory level. It hit again in 2018, and look at now, we're going to see a big drop off in manufacturing production, and this is going to put a lot of Americans out of work. Here you can see even more evidence as Lululemon sinks 15% on slower U.S. store traffic and weaker outlook. So we're seeing signs all across the U.S. economy, all across the world economy, that consumers are cash strapped, they're spending less. We're seeing it in the transportation sector, we're seeing it in the retail sector, and what this means is a lot of layoffs are coming. Visits to U.S. stores slowed at the beginning of the year as shoppers bought slightly less than a year earlier. U.S. traffic slowdown has been across the board, the company said, and it wasn't particular to a specific category. And it makes perfect sense when your paycheck's shrinking and your bills are increasing. Well, you don't go to the store nearly as much, and that means layoffs are coming, and in a big way. This is what FedEx is ultimately warning about. When we look at average weekly hours of production and non-supervisory employees against continued claims, there's a point where employers cut hours that they have to start cutting heads, and you see that happen right here in the late 1980s. Hours worked are getting slashed. That puts people on the employment line, and there's your recipe for a recession. You see it happen going into the dot-com bubble. Again, the global financial crisis. It was starting to happen going into the pandemic, and it's happening now. The issue is right now that businesses don't want to cut people. They believe the economy is going to turn around, so they keep cutting hours. But there is a point where they're going to have to start cutting jobs, and in a big way. But not to worry, the Fed says this is transitory as Goolsbee sees inflation from one-time tariffs. Imports are only 11% of GDP, so one-time tariffs that are not followed by retaliation and that do not spread out of what they're initially applied to, they're more likely to be transitory on inflation, and monetary policy would look through that. So from the Fed's perspective, we're going to see a one-time bump in inflation, and then at that point, prices are not going to go up anymore. Do you believe that? Weigh in the comments. Love to know what you think, because the bigger they are and the more like supply shocks they are, the harder it is to say that we should look through them. And so the response to tariffs amid slowing incomes is the Fed could say we're going to raise rates and try to crush demand even more. So what you can see is what the Feds indicate. If this inflation is sticky, if this tariff war is extended, they may raise rates. They may need to bring demand down to bring prices down, but what they don't realize is they're going to push us right into stagflation. And Goolsbee said that hard data still shows the economy is strong, and repeated, he expects rates to come down in the next 12 to 18 months should inflation continue to cool. And if you get a stagflationary recession, you will absolutely get inflation down. And the Fed won't be cutting just twice in 12 to 18 months. They'll be slashing right back to zero. And you can see the evidence that inflation is coming down simply based on the number of weekly hours, now shifting that to red against the consumer price index in blue. And what do we see in the 1990s recession? Hours worked are getting slashed, inflation jumps, and then it comes crashing down. We see it happen around 1994 as hours go down, and that keeps inflation at bay. We see it happen again in 2000, going right into the dot-com bubble. We see it at the cusp of the global financial crisis that causes a big increase in energy prices to reverse into outright deflation. We see it happen again in 2012. And look where we're at now. Hours worked continue to decline, and if inflation surges higher, well, that means demand is going to get outright crushed. It means companies like Nike that think they're going to pare down their inventory levels, well, they're going to have to slash prices even more, because what it suggests is as paychecks continue to shrink, demand from the U.S. economy is going to go down with it, and along with that, inflation. The current modestly restrictive stance in monetary policy is entirely appropriate given the solid labor market and inflation still running somewhat above our 2% goal. This from Fed Speaker Williams. And again, they don't realize that the labor market is right on the cusp of breaking apart. So you can go back to what FedEx is warning about. They're saying, look, shipments are starting to decrease. Nike saying, look, inventory levels are too high. Lululemon saying we're not seeing foot traffic. And what this translates all into is the U.S. economy squarely headed into recession. Now you know why FedEx warning is absolutely frightening to the broad U.S. economy. But just because we're likely to see it head into a recession doesn't mean you can't profit. Let's take a look at our CT Timer Pro trade on Brazilian equities going back to the 10th. That's up 8.18% as of close of business yesterday. We gave our subscribers the buy it open signal. We told them where to put their stop loss levels because this was an incredible trade. It wasn't just the fact that momentum and the trend was rising. We saw machine positioning, and what we noted based on a historical basis, the machines were going to have to buy, and they sure enough they did, driving the price right up to the 200-day moving average. Now, each and every day we scan the machine positioning across the broad equity, bond, currency, commodity markets, but we do something very special. We run a historical overlay so we know when the machines are likely to have to buy and when they have to sell, so we can position our subscribers ahead of a big buying spree and get them out before the machines sell. That's integrated right into our report. Now, you get the daily reports, you get all the signals, but I review each and every trade and put in the notes box right below the report my opinion on the best trades. Again, the back-tested data fully integrated into the reports. We give you risk control levels, full tracking of trades and returns, a weekly update, disclosure on how I'm trading my own book, and on top of that, you get a free 30-day free trial. We do that because we're so confident that you can make money trading our reports. We want your first month to be on me. Hit the links in the description below, grab the coupon code for a free 30-day free trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.